This is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Lucian Gindorf, and this is The Steward's View. It's so good to be back with you. This week, you can check out the economic and market roundup we usually have out at astewardsview.com. That's astewardsview.com/blog. Today on ASV, we'll begin a series focused on a mindset of peace when it comes to any area of life, your finances, and even your portfolio. We'll consider what does and what does not need attention from you and or your advisors, and we'll work to keep the portfolio in its place in support of your plans. And so loosely, I'll call the series Peace About Portfolios. This will be the first part in that series. It will not be an ASV Plus that we're working on for you in the next week or so, but we're going to stay on investment for a little while longer here yet in this series, and then delve back into financial planning topics and decision points, and then repeat. That's economics, investment, and financial planning. Those are the three areas that we want to tie together in this program to enhance or to level up your decision making. But in this case, we want to help you do more than just tune out the noise, okay? And that's to look towards a perspective of peace, to try to gain a perspective of peace, or help you see kind of how that can work for you in terms of daily living, God's provision, decision making, and yes, planning and investing. So again, we'll stay with investment here for a couple of weeks. We will add an ASV Plus episode I'm looking forward to. That's a more advanced detailed episode geared towards our institutional listeners. And then we'll also have an opportunity to move back into financial planning after that. So I'm looking forward to this series very much. As usual, this week we'll work to integrate the knowledge and the wisdom needed for excellent stewardship. Our goal is to elevate and enhance your decisions, including with your professional advisors. So before we get going, let's take a minute. Let's examine our work in the context of God's word about stewardship. In the book of Isaiah 26, and this is verse 3, we hear, "You keep him in perfect peace, whose mind is stayed on you, because he trusts in you." Very simple. You keep him in perfect peace, whose mind is stayed on you, because he trusts in you. There are a few takeaways that I can see right away. In the original Hebrew text, this is written as shalom, shalom. Okay, so perfect peace is written as shalom, shalom in the original Hebrew text, and that repeated word emphasizes a complete or absolute kind of unshakable peace. And then also a stayed mind. The term stayed means to be fixed or anchored. Leaning steadily describes a mindset that intentionally focuses on, Lucian, can you guess? That's right, it's God instead of the surrounding circumstances, right? Or our financial picture or whatever. So the root of trust, true peace is not the absence of trouble, but the result of secure trust in God's character and promises. So very easy to say, not so easy to do. It's a hard exercise, isn't it? It's just not a mental assent that we do. And so it's a heart-driven mindset that we bring to our decisions, including the financial ones. So I want to encourage our listener base to consider those thoughts and others like them from Scripture, from God's Word, that give us an idea about how we can just gain more of God's view of things, right? His kind of view, so that when we go to make decisions about our finances, or any area of life, but we're here about our finances, portfolios even, this very noisy, very busy, very intense area of our financial lives. This one really crazy line on our balance sheet called marketable securities that gets all of this attention, right, on Wall Street and Main Street. So, what are we bringing? What perspective do we bring to that decision making? And so here we are. These verses, they fit with the major idea associated with a steward's view, and that is that we're stewards or managers, not the ultimate owners of our financial picture, not the master of our own destiny. This is commonly thought. So our financial resources then are just ours for a short time, and we can make decisions from there. So with that in mind, let's look at our core content for today. A few things I want to talk about today regarding investing. We recently recorded an ASV Plus that I'm very proud of. I've shared that, Lucian, with a number of new listeners as well, and it's gotten some pretty good traction as I understand it. We're getting a lot of interest on the social media pages, actually, on Instagram, and I can't speak to TikTok because I don't have that active on my phone, Lucian, but we've had a lot of follow requests coming in on Instagram. So this has been going well from an attention-getting standpoint, but in that episode, ASV Plus, it was called "Do the Optimal Thing." I mentioned the idea of how holdings in portfolios work together or don't. Okay, so what we want is for them to work together. How we know if they're working together, those are the unsung heroes of this episode. Okay, and I mentioned a piece of this in that episode called "Do the Optimal Thing." And frankly, I glossed by it because it's so uncommon to talk about, even though I'm doing it and others aren't necessarily in terms of my day job at Fidera Advisors. By the way, this is not my day job. But when I'm doing my day job and I'm looking at these things and I'm evaluating portfolios and I'm trying to bring clarity to where in the world are we going to invest, who are the great asset managers that we want to hire, and then how do they work together, right? Those are three questions that I'm trying to answer day in, day out, except for Mondays when we're doing this work. So the very first report that I want to run when we've got, an aggregate portfolio, right? Any dollar amount. My firm's minimum is $1 million. Our average new account is just under $2 million. It doesn't matter if you have $1 million or not. What matters is that for sure a few key things about how your holdings are working together or not, right? And the first, as I mentioned from that one episode, is the correlation matrix. Okay, so there was a case study in that episode. We talked about a retiring couple who had done so well in so many things, and they were ready at a young age to retire very successfully, and that's been the steps that they're now in. Okay, so but the correlation matrix told us that they had a very highly correlated portfolio. Okay, so that's an indicator, that's a flag, right? And it just is saying we have things moving all together or more together than needed, right? So the idea of diversifying assets, if that's a goal, right? And for most investors, it is a goal. It can be examined in this way to say, all right, well, did we actually diversify? In other words, is the behavior of what I'm holding, or as I start with the areas of the world I want to invest in, are those areas moving in the same way? Now, there's a good argument to be made that the world is more correlated than ever, right? We're in a digital era. We're in a time when information is readily available and quickly available. And I often say the world is more correlated than it was, in recent history. So when we go to look at a correlation matrix, we have to keep that context in mind, but we can still kind of spread things out in a way that's more fruitful as to where we're going to invest, and then what the holdings are once we've done it. Okay, so if you're coming in with an aggregate portfolio, which I often encourage, right? You can go to fideraadvice.com/fusion. You can sign up for free for the aggregation system that's there, and that'll bring you into a view where you've got an understanding of what the holdings are, as a complete list from any any asset house, any advisory firm, any shop that you're set up at, wherever you have investments, and you can take that aggregate view and you can get this report. Okay, and I'm going to put a sample of this out. There'll be a few samples today, but out at astewardsview.com/blog, and you can pick up that correlation matrix from that exact case study that I mentioned as to our ASV Plus here a few weeks ago. But it'll show you, with the idea that everything is more correlated than it has been in the past, we still can kind of separate out the way that the holdings act together. Okay, so we don't want, I refer to cylinders in an engine a lot. We don't want everything to go up together. We don't want everything to go down together. Right? So a classic example in the last couple of years, and I add this for color and reference both, is gold. Okay, so gold is having a rotten year this year. Well, the 2 years prior to this, gold did really well, especially in 2025. Okay, and I actually had all these kudos coming in for holding gold. Well, I've held gold in portfolios since 2006. Okay, and I mean, I can't remember a time since 2006 where I've had more attention to this holding. All right, now I won't go into the why I hold gold. It's a currency hedge, basically, for everything else that's going on with our models. But the point is, the price of gold in 2025 shot up, created these great returns on paper. Everybody got excited. I even get excited. I mean, I want everybody to win. So great. Gold did really well. All right. Well, this year it's not doing so well. Okay. So that's just a rebalance, right? We're going to sell off what did well. We're going to reinvest in what didn't do as well. But the point with that I want to make is that the areas like emerging markets that didn't do well last year, that's an area we're going to reinvest in. Okay. Well, the common way of thinking about an asset when you pull up your statement or you log into your account is to say, well, gee whiz, emerging markets didn't do very well in 2025, so I should get out of that. Right, Lucian? That's the idea? Well, this isn't working. I should just change it. Okay, so we got to zoom out. We got to go to the 5-year view and the 5-year Sharpe ratio of the entire thing. And then we got to look at the correlation matrix. Say, okay, well, guess what? Gold and emerging markets are very uncorrelated. They're lowly correlated. What does that mean? That means that these are two very different cylinders in the engine. Okay, so what I want to do is I want to have one firing at a different time than the other. Right? Well, why would I want to do that? There are a whole bunch of reasons for it. But at the end of the day, if on the overall, when our whole effort here is to give consistency to investors, not to give them the flavor of the month, not to give them the greatest trade that they could ever want or have or think about or talk about at the cocktail party, but to get a consistent pattern in support of what? Whatever the goal is, the life goal and then the financial goal, right? What does it cost to educate my kids? What does it cost to retire a certain way? What does it cost to give, to be generous the way I've been led to be? What does it cost to leave a legacy? So these are things that when we talk about investing in marketable securities and so much of the complexities that go on with managing money that I actually don't go into, thank you very much, is we want to make sure that we're beyond responsible, right? So when we talk about optimizing a portfolio, there are lots of ways to say, I'm going to optimize a portfolio. That sounds really good. I can beat on return, right? Be Bill Miller or Peter Lynch in the last 3 decades. They're the only two people that have beat the S&P 500 running a fund. So Warren Buffett would be a third, right? It's not a fund per se. It's trades as a stock, okay, Berkshire Hathaway. So let's call 3 names that have beat the S&P 500 in the last 3 decades. Okay, on just return, right? Let's go to the idea that you could dial down risk from the S&P 500. You could have a standard deviation below 15. What's standard deviation? Total risk, right? You could do both. You could have some combination of the two. So when we talk about optimization, I don't want to go into what I mean by that. I'll defer to that episode we did for ASV Plus called Do the Optimal Thing one more time. It's a great episode. I encourage you to listen to it and share it with your advisors and have those conversations. But the correlation matrix tells us whether or not we're on track to do optimization. It tells us whether or not the things that we're holding, and again, I start with the aggregate, the picture of where in the world to invest, who's managing underneath of that, and then the holdings underneath of that. Okay, so I'm going to offer in this episode, before we close, 3 different reports that deal with all those levels. The correlation matrix that I just mentioned are the holding, are the areas of the world, sorry, I keep saying holdings, the areas of the world, are they moving together or are they not? Right? Think of them, think of like master asset classes. Holdings then. How are the holdings that if we have asset managers hired, like my firm does, are those holdings overlapping? Do I have 3 or 4 asset managers doing the same exact thing in terms of what they hold? Or something similar? And 3, what is the actual intersection? Right? In other words, when I look at everything together, if I have, 1,000 underlying securities all over the world in 15 asset classes, like we do at Fidere Advisors, and I'm throwing out 1,000, I don't know what the final number is of underlying securities, but if I have, an 80% equity portfolio, that's a global mix, and then 20% fixed income and other, of the stock portion, especially the equity portion, what is the percentage that's in the Mag 7 as a kind of common conversation? What is the percentage that's in NVIDIA? What is the percentage that's in anything? So that's a stock intersection, right? So there's 3 different levels here of reporting that we can look at to figure out, do I actually have something in, on the way to optimization, right? And these are unsung heroes. These are super boring, not interesting, data-driven reports that are going to help you do what? Do a good job of either saying, hey, I have, engines in the cylinder going up together, right? I have high degrees of correlation, overlap, and intersection. Or I don't. Or I have less than what? Less than the benchmark, less than the marketplace. That's a way to think about, you got to compare to something, right? And by the way, in comparisons, I like to have current holdings, the benchmark that's relevant, or benchmarks, plural, and then the optimized model, right? Doesn't have to be Fidere's model, but something that's optimized to do a certain kind of work relative to the benchmark. Okay, it could be working on return, could be working on risk, could be working on both. Okay, again, the 5-year Sharpe ratio, maybe the 3 of what? The aggregate. So I bring all that up because these reports are super available, often not used, overlooked, and may or may not be part of an investment process that you or your firm is going through. So I'm going to post those. I won't read from them. I will say that in the optimized model from the case study mentioned in our last ASV Plus, that the correlation for the optimized model was much lower, and so was the holdings overlap and the intersection of stocks. So, one usually begets the other. Okay, so that's a big FYI, but I want you to see what those reports look like, and I also want you to get them. Okay, and I want you to encourage your advisors to bring them or to find them or do something to consider these points if they're not already. They may be, but the point here is, let's not miss these important points of analysis. Because why? Because if all we need to do is go hold a concentrated portfolio of the same 30 stocks that we're already holding, and we've all done all this work just to end up in the same place, then let's just go buy the 30 stocks, right? But if in fact we can diversify enough, I'll say enough, we can manage correlation to to a better place, right, of low or negative correlation among what? Asset classes. I gave the example of gold and emerging markets the past 12, 18 months. Then we've got something, right? And why is that important, by the way? Because when you as I've defined optimization, we have to keep coming back to what we mean by optimization, right? I've defined it as getting a better risk-adjusted return over a 5-year period of time, backward looking, due to a superior standard deviation, keeping up on return. Okay? So when somebody comes into our offices and says, well, what can you do for me? What's your performance? If they're willing to talk about this, then what we're going to do is we're going to look at risk and reward on the aggregate level. We're going to look at the correlation matrix and these other reports I mentioned. And then we're going to help them come to clarity about where they actually need to be positioned, right? And maybe it is the 100% equity investor. I mean, I have a number of those to serve, and they don't need much. They just really need X amount of growth, and they want to line up and be solid on return and dialing down risk wherever possible. Okay, so there's a lot of what ifs in this, but I want to mention these unsung heroes of portfolio allocation, because if we don't do this, we end up very, very uninformed, very misguided, even as it may be, when it comes to the interaction of holdings together, right? And so again, I'll post all of these reports up from the case study mentioned tonight before midnight at stewardsview.com/blog, along with our weekly roundup. Other thoughts. So, I want to just touch briefly on advisory relationships. Okay, I've kind of mentioned advisory relationships a few times in recent weeks. This program is absolutely designed to support them. It's designed to encourage them. It's designed to open conversations with them, them being what? The investor and the advisor and the investor, whoever the investor is. It might be a person, it might be a couple, it might be a family, it might be a trust, it might be an endowment, a foundation, right? And so, I'll leave some thoughts with you. And these are not questions to ask your advisor that have been asked or stated, 1,000 times that you can find on AI. But I'm going to challenge you on purpose when it comes to these relationships that, again, I'm supporting and I want you to have fruit in. One, where do they come from? Do they come from 401k plans? Do they come from an insurance company? Do they come from a brokerage? Maybe somebody you met at the Thanksgiving table? Okay, consider where they came from. Okay, that's not a good or bad necessarily, but don't forget where they came from. And then secondly, what do they look like? How do they function? Are you working with somebody closely? Is it occasional? Is it never? And what's the nature of the service? Right? If it's brokerage, that's fine. If it's advisory, that's fine. If it's wealth management, that's fine too. Insurance is certainly fine. So, maybe it's a family office. Maybe you're one of the few that gets to do that as an owner, a family that owns its own office. That's great. What do they include, right? What does it cost and what do they include? And so I want to mention a couple of references along these lines. Okay. Again, I'm challenging. Where do these relationships come from? What do they look like? And what do they include? Okay. If you're not sure, try to answer those questions. But if you're not sure about kind of what to expect, then after you've thought through those questions, I'm going to offer a chapter here I wrote down 15 years ago in the Life Cycle of Wealth book. And we'll put that up on stewardsview.com as well tonight. And it's just called Finding Your Fiduciary. Okay. And I won't go into a rant in this episode, Lucian, about fiduciary work, but genuine or true fiduciaries act as trustees for their clients. Okay. And the ideal relationship you can have with a fiduciary, in my view, is one that functions like a partnership. So I'll just leave it there. But I'll put that chapter up tonight. You can consider the 5 different types of financial offices so you can understand where you're at. Then something more about what you can expect. But because the things that we're bringing out, especially when we talk about investing, the things that we're bringing out, this is not watch sales. This is not products. This is not anything to do with commissions or pay structures, right? This is straight advice. Okay, so, if somebody calls themselves an advisor, just clarify what that means. Okay, I'll leave it at that. So those are some thoughts I wanted to add to this particular conversation. As far as other things, I don't have a lot else for today. Lucian, how about you? Okay. Well, if you have any questions about what we've talked about here or what you read out at stewardsview.com/blog, please let us know. You can find just plenty of resources with past episodes, the past year and a half there. You can email us, team@astewardsview.com. That's team@astewardsview.com. And now, thanks to Lucian, we can also, you can check out the social media pages, Instagram, TikTok, YouTube was there. And now, I don't know. Is that it? Did I hit them all? Okay. So that's all out at astewardsview.com. So we've covered a lot of ground. This has been a joy to be back. I hope this has been a blessing to you and others you decide to share it with. From all of us here at ASV, we look forward to what's ahead. Next week, we'll continue the series, Peace About Portfolios and the Decision Points Associated. Until then, let's connect at astewardsview.com. Thanks for joining. Please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.